over the last month or so, the broader market has been trending downwards. Meanwhile, my portfolio has been pressing forward and hitting all-time highs. So, in this video, we're going to be taking a look at why my portfolio has been doing so well, while the market has not. On top of that, I'm also going to go through Goeasy's Q2 earnings and give you my impression on the report. And I will be touching on what I think of the board's plan to replace the company's current CEO. My name is Paul, and so far I've invested $100 per month into Canadian securities for 32 months straight, with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. And I'm doing this series to try and show that by following a disciplined plan of investing $100 every month, the average Canadian will be able to achieve retirement and live happily off of their investments in financial freedom. Getting into why my portfolio has had such a strong month relative to the index, well, I can tell you that it was not because of MTY Food Group. MTY is a company that owns and franchises out 90 different restaurant brands, including Cold Stone Creamery, Wetzel's Pretzels, and Baton Rouge. And if I had to put a label on my investment hypothesis for MTY, it would probably be a turnaround. The company is definitely going through a challenging time at the moment, with store closures outpacing openings, mostly because the company does have some weaker brands that simply aren't performing the way that they used to. Plus, you have slowing sales out of the retail segment of the business, and you've got increasing wages. That said, the company has a ton of free cash flow coming in, and it's priced very cheaply. And with some strong brands pushing growth, I hypothesized that it's just a matter of time before the growth of banners like Cold Stone and Wetzel's start turning the tide and improving investor sentiment. But until these results materialize, the stock will continue to remain depressed. And with no news or changes coming over the last month, the share price continued to drift downwards by another 3.8%, ending the month at $41.86, down from the $43.50 where I purchased shares at the start of August. Now, even with MTY making up more than 1/6 of my portfolio and it performing poorly this month, I still had a very strong 1-month performance. And this is because I like to make large concentrated investments into securities where I believe my money is best served, which is why the majority of this portfolio is made up of shares of the Morguard North American Residential REIT, which increased from $16.58 at the start of the month to $18.48, which is an 11.46% gain. And that's before including MRG's monthly dividend payout. As of this moment, nearly 3/4 of the monthly portfolio is invested into this REIT, and that's for a few main reasons. First, the REIT's business model involves renting out apartment units within the buildings that it owns, and rent is always going to be something that's in demand, so right off the top there's a fairly high level of income stability. Second, the REIT is heavily discounted. In last month's episode, Ticker hadn't updated its Q2 information on the REIT's tangible book value per share, but now we do have that information, and even though Morguard's current share price has risen, the underlying net asset value per share is still more than 2.8 times higher than the price point is today. And finally, the management, and more specifically Ray Sahi, who is the founder and CEO, holds a majority ownership stake in the REIT. And Ray has consistently made good decisions that benefit shareholders, most recently authorizing the repurchase of tons of shares, locking in the discount between the net asset value and share price for the remaining shareholders. These 3 major reasons, in addition to the countless hours of research into the company, its competition, and possible investment alternatives, make me confident in investing the majority of my portfolio into the REIT. This strategy of making large concentrated investments can oftentimes lead to extremely concentrated results that by many are deemed to be risky. And that's not even necessarily incorrect. See, the more concentrated your portfolio is, the more likely you are to experience significant downswings if you're incorrect, or if the securities you hold fall out of favor or have other negative catalysts working against their upwards price movement. In fact, my portfolio being so heavily concentrated has suffered considerable underperformance over select periods of time, as you'll come to see in the following segment of this video. However, being heavily concentrated has a counterbalance in that it puts investors in a position to substantially outperform when they invest correctly. So, in essence, my goal is to find an investment that provides a near certain likelihood of strong long-term returns and a very low chance of capital loss, aka risk. And once I've pinpointed an opportunity that meets my threshold for success, I invest heavily. This strategy goes against one of the more broadly accepted philosophies of securities investing that is accepted today, that being diversification. And to be clear, I think that diversifying is a very good strategy for the majority of investors who don't have the time or interest to scour exchanges going through the listed securities from A to Z, peeling through quarterly reports, and listening to conference calls. But as someone who has considerable experience and who does take the time and effort to unearth undervalued securities, I can't imagine a worse decision than to find what I understand to be the best opportunity in the market and only invest in it marginally with the intention of holding back capital to ensure that there's extra money left over to put into less certain opportunities. If I've already isolated the top security that's positioned to make strong near certain returns, why would I ever put my money into something that's considerably less certain or less capable of producing results? Doing so just wouldn't make sense to me. None of this is to say that the monthly portfolio will never hold more than just the few securities that it does now, but as of this moment, I have a little desire to invest in opportunities number 4, 5, or 6 on my watch list, let alone number 10 or 15. In fact, more often than not, I'm only investing in my top 2 ideas, though this month may be an exception to that. And that's because Goeasy just released their earnings, and once again, they were pretty incredible. Loan originations for the quarter hit a brand new record high, up 24% year over year, and over $100 million above the company's previous best. This pushed the value of the loan book to a record of $4.1 billion, up nearly $1 billion over the course of the year. And this was all while the company has been lowering its average weighted interest rate for borrowers, officially coming in at approximately 29.5%. These lower rates and the growth of the loan book is coming largely because the company has begun refocusing its efforts on growing home equity lending, a category that's increased by over 55% year over year for the company. See, these housing loans, while profitable, are also lower risk since the loans are secured by the home, increasing the incentivization for borrowers to repay since no one wants to lose their home. And with interest rates starting to decline, this is a good opportunity for the company to start writing more home equity loans since rates are less likely to increase to the point where the company's clients are defaulting, which is good for both parties since Goeasy just wants to collect interest and doesn't want to deal with selling real estate. And borrowers, as I said before, obviously don't want to lose their homes. On top of that, guidance was also up in most areas. 2024's projected full-year guidance for the consumer loan book has increased, with $4.55 billion, the previous high-end expectation, now coming in at the low end, with the high pushing $4.65 billion. And guidance for 2025 and 2026 has also increased by $0.2 billion on both the high and low end across the board. Additionally, high and low end guidance for total company revenue has increased by $50 million across the board for 2024 through 2026. And finally, the company's projected operating margins are also expected to increase by an additional percentage point in 2025 and 2026. But not everything here was gravy, since the net charge-offs on both the low and high end are expected to increase by 25 basis points in 2025 and 2026, though this isn't really a huge concern. Now, if you remember from my past coverage of Goeasy, the federal government of Canada has put into motion a plan to reduce the maximum allowable interest rate on loans to 35%. And this change is expected to be forward-looking, meaning that any loan written prior to the law coming into effect will still be considered legal even if it is above the 35% maximum allowable rate. Well, the government, being the slow-moving machine that it is, was expected to have this new law come into effect in mid-2024. But according to Goeasy's management, it now looks like that won't actually happen until the beginning of 2025 at the soonest. This means that the company will have an additional half a year to write loans above the upcoming 35% maximum rate for customers who otherwise wouldn't qualify for sub 35%. So, more loans will be written and more customers will be served than was expected, which did have a positive impact on the upcoming guidance. In a spot of bad news, net charge-offs and delinquencies were up this quarter, with delinquencies hitting their highest point in years. Though this was noted on the conference call as having to do largely with secured loans having longer charge-off cycles, meaning that these loans will sit as delinquencies for longer periods of time before becoming considered a charge-off. With the company now concentrating more on growing their home equity lending business, they're creating more secured loans that, when unpaid, will sit as delinquencies for longer periods of time. This, in part, is why there's such a large increase in delinquencies without seeing a proportional increase in charge-offs. That said, the relatively smaller increase in charge-offs was explained as being due to the weakening Canadian economy, which recently saw unemployment hit a 7-year high of 6.6%, though charge-offs were still well within the forecasted range. And the last update that I have before moving on to the CEO transition news is that the company's new credit card product is expected to launch sometime in 2025. As for the CEO, Jason Mullins, we already knew that he was going to be stepping down in a year, and that he'll be staying on with the company as a member of the board. But we learned that the company is searching globally for somebody with prior CEO experience, and that Mullins will help support his successor through the transition. Personally, this was a bit surprising to me since I figured the company would promote someone from within who's already familiar with the company's winning culture. But it sounds like the board believes that the culture will be easier for a new CEO to learn and adapt to than to promote someone who understands the culture but needs to learn the role. Generally speaking, I do prefer to see internal promotions because you get the sense that the person is already familiar with the day-to-day of the business, and they already have an understanding of the culture and values that make the company tick. But seeing as Mullins and the former CEO David Ingram will still be active members of the board, I don't think that they're going to let someone new come in and screw things up too much, especially since they made several mentions that they're not planning to materially change the culture in any way. And that was Goeasy's Q2. And after everything was said and done, the stock basically froze in place at about $185. But towards the end of the month, the stock did come down a few dollars more to end things at $182, down about 10% from the nearly $200 that shares were trading at in the beginning of August. So kind of surprising that the continued strong results and even stronger guidance weren't enough to push the company over the $200 mark. Personally, I do think that the weakening economy and the amount of debt that the company carries is a good reason for it to trade at a low earnings multiple. But at this point, I feel a bit more comfortable picking up shares for the time being, especially with interest rates starting to decline. Now, in spite of only the Morguard North American Residential REIT providing a positive 1-month result, the portfolio still managed to make a massive push forward, with the grand total for August coming in at $3,588.53, which is up 7.3% on the $3,343.85 that has been invested, which does include the reinvested dividends. But without including the reinvested dividends, the portfolio would be up over 12.1%, or $388 on the $3,200 that were deposited. Taking a look at my portfolio versus the benchmarks, this was clearly the best 1-month nominal performance that the portfolio has ever had, as you can see represented by the green line. We smashed last month's record net gain and made up considerable ground against the competition, all of which had lackadaisical performances. Unfortunately, my portfolio is still in last place, but if momentum continues to be on our side, it'll only be a matter of time before the portfolio is sitting back above the goal line, which is now within $150 of where we currently stand, That's less than a 4% gain away. And yeah, within about 4 months, we've gone from below breaking even to being right back in contention with the rest of the benchmarks. And I think we could be back on top if Morguard keeps doing what it's doing, and I keep doing what I've been doing. Now, I've already put this month's $100 into my account on Wealthsimple, and I also have a little extra dividend income that I've earned over the prior month. And I'm going to start things off this time by taking advantage of the Morguard North American Residential REIT's discount, and I'm going to purchase 4 shares. Next, I'm going to be buying $25 worth of Goeasy, which is looking too good to ignore at $175 per share. And last up, I'm just going to be putting the remainder into MTY, which I think will probably have more opportunities to buy cheaply over the coming month or so. As for the end result of September's investing, I was able to pick up 4 shares of the Morguard North American Residential REIT for $18.34 each, 0.1424 shares of Goeasy at a cost basis of $175.56 per whole share, and 0.3429 shares of MTY Food Group at a cost basis of $41.52 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, as of the market's close on Friday, September the 6th, the portfolio has 147 shares of the Morguard North American Residential REIT worth roughly $2,684, about 15.6 shares of MTY Food Group worth over $647, and 1.76 shares of Goeasy, which are now worth exactly $309. Moving over to the dividend tracking chart, in August the portfolio brought in a record $12.60. Most of which came from Morguard's monthly distribution, and the remainder came from MTY's quarterly payout. That's enough to buy almost enough brand name coffee to get you through a month's worth of mornings, depending on the severity of your addiction. Personally, I don't drink coffee, so all that money is going to be reinvested so that our dividends will snowball. Now, sadly, next month is the slowest of the quarterly cycle, with only Morguard expected to pay out $8.81. But after that, things will pick back up as we enter into the final quarter of the year. And in terms of our goal, it looks like 2024 will be a pretty close call, as we're now sitting at $76.12 in cumulative dividends thus far. And the goal is to make it to $130 by the end of the year. As everything currently stands, we probably aren't on pace to make it, but we are expecting a hike to be coming in the next few months, which could line us up perfectly to hit our target, but we'll just have to wait and see what transpires. Now, looking at the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $134.50, which is a 3.07% increase from what was expected last time. As for the portfolio's percentage yield on contributed capital, this month it stayed the same at 4.08%. And that's going to conclude this month's episode. So thank you all for watching, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.